Carley Garner, senior commodity strategist with us and broker of D. Carley Trading. Always good to have you with us. Looks like gold taking a similar kind of reminiscent type move of a risk-off type tone, flight to quality as investors express concerns.
You're exactly right. I personally think this is kind of a repeat of what we saw in 2011 in gold. And if that is the case, we should continue to break above 2,500. And my target's somewhere around 2,650. Yeah. So, one thing to keep in mind is the seasonal low in gold is usually July 24th. And like clockwork, we sold off into that level. We found a base last week, and it happened to be an uptrend line where buyers stepped in. And so the path least resistance should be higher. I think from a fundamental standpoint, we're probably seeing a situation where, prior to the last couple of months, interest rates were very high. And so it's hard to justify holding gold, an asset that doesn't pay dividends or interest, when interest rates are high and the stock market's flying. But we're starting to see those things unravel, and that makes gold a lot more attractive. Further, we've seen the yen finally crack. The downtrend in the yen has been broken, and I believe the yen probably has seen the low and is heading higher. And if that's the case, this is something very similar to what we saw prior to the financial crisis. I'm not saying we're going into a global financial crisis, but I do think we see a recession. And in that scenario, once the yen rolled over, it basically opened the door for gold to move higher, risk assets to move lower, and that sort of thing. So that's kind of what we're looking for in the next couple of months.
Yeah, I'd agree. Multiple contributing factors here. And to that point, we did see, since the FOMC meeting began, the 2 years come off, the yields have come off from 4.4 to 4.1%. And here, as I look at them at the overnight session here, actually, 4.1 is the overnight low here for the 2 years. So taking a look here, Carley, at, again, just these contributing factors. I'm happy to have you on here today because in a very timely fashion, oftentimes you can walk us back from the cliff, right, and getting too euphoric, getting too caught up in the price activity. But it sounds to me like you think this one's the real deal.
I think it is, but I will also say when it comes to gold, like a year ago, we were looking for the typical summer swoon to get bullish, and we were talking about gold in the 1800s. Now we're talking about gold in the 2,500 area. So while I am bullish fundamentally and technically, I think the upside is starting to get a little bit limited relative to the downside risk. So if you are a gold bull or you're holding gold, this is probably not the time to tap the gas. It's probably a little, maybe some time to take profits and maybe keep some exposure, but be a little bit careful. Because the thing about gold is, it's not a buy and hold asset unless your time horizon is decades. I mean, we've had a couple of decades where gold literally trades sideways, or even worse, gives 30, 40% back, and then it takes you a decade to get your money back. So as much as we like to talk about gold being a diversifier, and it also isn't necessarily a buy and hold investment for everybody, unless, again, your time horizon is really, really long.
Well, one of my favorite stories is the wife of the guy who got me onto the trading floor and got me my first running job. She always boasts about these gold coins she's had since around $200-300, and some that she even bought cheaper ultimately. But when you look at that longer term trend, pretty easily identifiable again across multiple time frames to the upside. But let's talk a little bit about crude oil right now, because that's been another product that we've been discussing this week with some major intraday swings, right? You've got geopolitical tensions, not only giving gold a lift, but it seems like kind of providing a bit of support for crude, while Trump administration talking about drill, pump, baby pump, I think it was, right? Or drill, baby drill. That is kind of, feels like it's got a bit of puts a weight on prices, in addition to some of the economic concerns that we're dealing with.
Exactly right. So the crude oil is basically, for the last 7-8 months, we've been hovering around the 200-week moving average. Right now, I think it's about 77, 78. And the thing is, this is a very equilibrium price. Prices are not high enough to lure additional supply, not high enough to thwart demand. So we're kind of in a sweet spot here in crude oil. But I don't know everything there is to know about crude oil. I can't see the future. But what I do know is when crude oil gets this quiet, we've seen the volatility collapse. We follow the CVol, which is the Commodity Volatility Index, posted on the CME Group's website. It's basically like the VIX for crude oil. And we're at one of the lowest levels ever seen in oil. Generally speaking, timing is kind of questionable and the direction is questionable. But usually when you see volatility collapse like that, it's because speculators have kind of given up. They've moved on to tech stocks or whatever they're doing. eventually they will come back when there's an event that pulls them back in, and what it does is cause an explosion of volatility. So while I lean higher in oil, just simply because we're holding support, 74 is internal support, and then we've got another level at 70. As long as those levels hold, the path of least resistance should be higher. For seasonal, there's a seasonal tailwind that continues over the next 3 months. I already mentioned the yen. I think the yen rolling over is a sign that the currency market might normalize. That would push the dollar lower, and that's supportive for oil. So with that in mind, rather than swinging for the fence, I think speculators should focus on buying premium. It's not as sexy and as exciting as trading futures, but this is probably the best time to own volatility ever in crude oil. So if you're bullish, you could buy call options in the mid to high 80s with 100 days to go for less than $1,000. There's only been a handful of times in my career that I've seen that. If you're bearish, you can do the same thing on the put side. There's 3 examples of when volatility has collapsed to this level historically that stick out in my mind. The 2014, when the fracking bubble burst and crude oil collapsed from roughly 100 to 30. Right before that, volatility was low like it is right now. Prior to the COVID collapse, volatility was similarly low. And also going into the Russian invasion of Ukraine, we saw similarly low volatility. So I'm not saying we get one of those wild tail risk events, but I'm saying that we're in a lull, and that's probably not going to last. One thing I do know is volatility always comes back.
I remember that 2014 move lower through 100, built momentum all the way down to eventually it found that $30 level. Won't get into the pandemic move lower that we saw. But Carley, real quick, does your bullishness on crude change at all if the number that's headed our way in just about 5 minutes comes in soft? If we start to fear more that stagflation concern?
It's definitely a worry. What I'm doing is letting the chart guide me. So as long as the $70 holds, okay, and maybe if we tick to 69 and bounce back, that's not considered a breach. But as long as that level holds, I lean higher.
Okay. I like that. It's kind of the middle of the range that we've been in, going all the way back to, we're talking 04, 05. I mean, upper extreme around 150, lower extreme around $6.50. So again, it's basically right in the middle of that range. And that's something we focus here a lot on the Future Show, not just the upper and the lower extreme, but the significance of that balance area and that middle of the range. Carley, appreciate you joining us here, talking commodities as we await jobs report here today. And as the dust settles from what's been a crazy week, Carley Garner, Senior Commodity Strategist and Broker at D. Carley Trading.